Welcome back to our series on financial markets. In today's video, we are diving into the essential tool used by investors, analysts, and companies to evaluate financial performance, ratio analysis. So, what exactly is ratio analysis? It's a quantitative method used to gain insight into a company's liquidity, profitability, and solvency by comparing various financial metrics from its balance sheet, income statement, and cash flow statement. There are several key ratios we look at in financial analysis, and they can be grouped into categories. Let's break down some of the most common ones. First, we have liquidity ratios. These help determine how well a company can meet its short-term obligations. Two important ratios here are: 1. Current ratio. This compares current assets to current liabilities. 2. Quick ratio, also called the acid test ratio. It excludes inventories from current assets to give a more accurate reflection of liquidity. Next, we have profitability ratios. These measure how well a company generates profit. Two key ratios are: 1. Gross profit margin. This shows how efficiently a company is producing and selling its goods. 2. Net profit margin. This indicates the percentage of revenue that remains as profit after all expenses are paid. Then we have solvency ratios, which assess a company's ability to meet its long-term debts. The debt-to-equity ratio is widely used, as it compares the company's total debt to its shareholders' equity. Finally, efficiency ratios help evaluate how well a company uses its assets. Key examples are: 1. Asset turnover ratio. This measures how efficiently a company uses its assets to generate sales. 2. Inventory turnover ratio. This indicates how many times a company's inventory is sold and replaced during a period. Why is ratio analysis so important? It helps businesses track their financial health over time, compare performance with competitors, and make strategic decisions. For investors, it provides critical insights into whether a company is a good investment. To sum up, ratio analysis is a powerful tool for understanding the financial position of a company. Whether you're an investor, a business owner, or a financial student, mastering these ratios will help you make informed decisions. Thank you for watching. Make sure to like, subscribe, and stay tuned for more insights on financial markets in our next chapter.